A generation was promised a simple dream: work hard, save money, buy a home. But today, that dream feels further away than ever. Home prices have exploded. Rent keeps rising. Millions of Americans are asking the same question: how did we get locked out of our own housing market? This did not happen by accident. It was built piece by piece, policy by policy, decision by decision. To understand this crisis, you have to start with one simple truth. Housing in America is no longer just shelter. It is an asset. It is an investment. It is a machine for profit. The shift began decades ago. After World War II, America experienced a housing boom. Suburbs expanded. Homes were affordable. A single income could buy a house. Home ownership became the foundation of the middle class. But over time, something changed. Housing stopped being about stability. It started becoming about speculation. Investors began to see homes as financial instruments. Wall Street entered the housing market.
Everything accelerated. The 2008 financial crisis should have been a warning. Millions of families lost their homes. Entire neighborhoods collapsed. But instead of resetting the system, something unexpected happened. Large financial firms stepped in. They began buying foreclosed homes in bulk. Entire streets were purchased at discount prices, not by families, but by corporations. This marked a turning point. Homes were no longer sold one by one. They were acquired like stocks in a portfolio. Corporate landlords emerged at scale. They converted homes into rental properties. They held them long term. This reduced the number of homes available for buyers. It increased competition for what remained. At the same time, another force was tightening the market: zoning laws. Zoning rules control what can be built. Large areas allow only single-family homes. Apartments are restricted. Multifamily housing is limited. New construction is heavily regulated. This creates artificial scarcity. Demand rises faster than supply. The rules prevent expansion. Developers face long approval processes. Projects are delayed for years.
Many projects never get built. Fewer homes enter the market. Prices rise even faster. Local resistance adds more pressure. Homeowners oppose new developments. They fear changes to their neighborhoods. They fear declining property values. They use zoning laws to block new housing. This creates a powerful cycle. Existing homeowners protect their wealth. New buyers are locked out. The market becomes exclusive. Access becomes limited. Corporate landlords continue expanding. They use data to identify profitable markets. They outbid regular buyers with cash offers. They move faster than families. They pay above asking price. This pushes prices higher. First-time buyers struggle to compete. Saving for a down payment becomes harder. Wages do not keep up with housing costs. Debt continues to grow. Student loans delay homeownership. Credit requirements tighten. Interest rates fluctuate. Every barrier adds pressure. Every delay pushes buyers behind. For renters, the situation is no better. Corporate landlords optimize for profit.
Algorithms set rent prices. Rents increase across regions. Tenants have limited options. Moving becomes expensive. Availability becomes scarce. Affordability disappears. This creates a trapped population. People cannot buy. People cannot rent comfortably. The system feeds on itself. Higher home prices lead to higher rents. Higher rents make saving harder. Less saving means fewer buyers. Fewer buyers means more renters. The cycle repeats. At the center is an imbalance. Too much demand, not enough supply. This imbalance is engineered. Policies restrict building. Investors absorb inventory. Institutions benefit from scarcity. Wealth becomes concentrated. Property owners gain wealth. Non-owners fall behind. The wealth gap widens. Housing becomes a dividing line between stability and insecurity, between ownership and dependency, between opportunity and exclusion.
Younger Americans feel the impact deeply. Many delay starting families. Many stay renters longer. Many abandon home ownership. The American dream begins to shift. It moves from achievable to distant. There is another layer to this system: incentives. Government policies reward ownership. Tax advantages favor homeowners. Mortgage deductions reduce costs. These These benefits help existing owners. New buyers receive less support. Large investors access cheap capital. They borrow at lower rates. They scale faster. They think long-term. The playing field becomes uneven. Institutions compete with individuals. Individuals often lose. Technology amplifies the gap. Data analytics guide decisions. Algorithms predict growth. Acquisitions happen at scale. The market becomes efficient. The market becomes less human. Homes become numbers. Communities become assets. People become tenants. The future begins to shift.
Home ownership may decline. Corporate control may increase. Affordability may worsen. Change is still possible. Zoning reforms can increase supply. Policies can limit corporate ownership. Incentives can support first-time buyers. The system can be redesigned. Awareness is the first step. The biggest misconception is this: the housing crisis is not random. It is not just bad luck. It is not uncontrollable. The pattern is clear. This system was shaped by choices. Choices prioritized profit. Choices restricted supply. Choices concentrated ownership. Those choices have consequences. Millions are now locked out, not because they failed, because the system changed. The rules evolved. The players expanded. The game became harder to win. Understanding the system is the first step. Clarity replaces confusion. Blame shifts away from individuals. Questions shift toward the structure. That is where real change begins.